Welcome to the third session. This time it's very simple as usual. It has been split into two parts. First, we will talk about syndicate investments, and the second will feature five startups. Five startups will be attending. They will pitching their businesses. It's going to be a chance for you to also ask questions because each pitch will be 5 minutes, plus we will have like 5 to 6 minutes also for questions. So feel free to ask any interesting questions that you may have. For the second part, we will also have some of our members joining the room, so stay tuned for that. But for today specifically, actually before we go into that, I want to quickly move back to the second session that we had last week, where we wanted to showcase quickly some of the good and let's say some of those less good examples of startup pitch decks. For example, with the problem statement, again, we can begin in very active discussion. If you take a look at such type of a problem slide of a startup, do you believe it to be a good example or a bad example?
I mean, design-wise, it's terrible.
Okay, noted. Yes.
I mean, I think that this is like a logic. Like they have weak this, they have weak that. This is the like justified.
Yeah.
What is the actual problem?
Yeah, it's like they're solving everything at the same time. Nothing. It's like solving a status quo. So this is something that we usually kind of stay away from or try to understand more deeply. But then again, we have also examples like this. You can comment whether you believe it is a good one or a bad one.
Okay, kind of clear.
Okay, I mean, I guess it already became clear. It pretty much mentions all the things that you want to see. It's like the target audience being the online stores, what is the current situation, them basically using third-party tools, what's the problem in itself, slows down the performance, etc. Basically mentions all the necessary factors for you to understand it. Then again, there's also a different way of telling the problem that you're solving. It is through storytelling. I mean, any good pitch deck also and pitch presentation comes with some type of a story behind it. So there's always a way that you can present it by sharing personal experiences. But again, they have to be, let's say, more carefully validated, just trying to understand whether like this personal experience has like really been your only experience or this is like a general experience that this target audience comes up against. Yeah, about the competition as well. What do you think of this competition slide?
I know it's hard to say like are they big, are they small, it's small startup, big corporation.
Yeah, pretty much does it. Yeah, yeah, pretty much. I mean,
insiders.
yeah, exactly. In this specific case, yes, it was pretty much for insiders. Those from the industry understand who these names are, but from the investor's perspective, is the middle company any good? Like, how do you compare against them? Like, what are your advantages? You don't really know. And then you have slides like these. Again, I would say yeah, these boxes are just to cover who the company is, just so for your information. But again, yeah, this again shows kind of more better overview landscape of the market. Who are your direct competitors, indirect? How do you compare against them? Of course, the startup will always try to put in the factors where you are, let's say, number one against them. But again, you have to double check whether are those the most crucial factors that you are comparing yourself against to. But yeah, about the market, I want you to take a look at this example and tell me whether the calculations and the overall presentation make sense or doesn't make sense.
purely from visual perspective, 470998 asterisk 1 million something, it could be like, I mean, purely visual, just cut it to narrow figures, like to be readable at least, and then you can calculate if it's correct or not.
Okay. Other thoughts?
I think it's good that we have the references.
Yeah, the references I have cut out, but they are there. But in this specific case, it's not the most usual way that startups kind of present how they calculate the market, but it's good for the understanding of it. That you can actually see that the startup has put a thought behind on how he calculates the market size. But the only thing that I would say is, let's say, a little bit, let's say, problematic in this case is the SOM market size in overall. 20.8 million market size. And if you're a startup are now doing a fundraise at a 5 million valuation, you're already kind of implying that you're kind of already in the top percentile of the whole market share that you're targeting. So this could be, let's say, a case where the market size is, let's say, too small for your investment in that case. But yeah, we can skip this, skip this, skip this. About the traction, we can skip this. The team we already talked about. The one that I want to ask you about is the ask slide. Pretty much the last slide that comes up at each of the pitch decks. What do you think about this one?
What the investor gets back? Percent of the share.
Yeah, the valuation is missing here. Yes, that's one thing. Anything else?
Well, maybe it's figures again, like upsell, how much? Some quantitative.
Yeah, true.
Looks a little bit too much of to accomplish in 18 months. I mean, like some kind of prioritization.
Could be one way to look at it. But again, yeah, I think a good way to look at this would be what are the clear milestones of it. Of course, increase GMV to 10 million plus in 6 countries. Like, is it the goal of 18 months, or is it like, I know sometimes startups report the goals that they want to achieve in 2 or 3 years. So maybe something more specific in terms of also fundraising for the next round, etc.
And for me, it's missing where they are now. Like to achieve 10 million.
Yeah, that probably, yeah, true. Probably that would be in another slide, but yeah, true. What about this one? It's actually a company that we looked at quite recently yet. Do you like it? Do you not like it?
No, that's very precise.
Other thoughts?
Valuations.
Yeah, the valuation is again only thing missing. In terms of others' perspectives, I think it's very clear what's the goals, how do you want the company to look at after this fundraising part, etc. What do you think of this one? It doesn't say much, right? I probably should have mixed the slides the other way around, probably started showing you this and then to the good ones. But yeah, again, this is the type of slide where you don't really get any context of what the company is trying to do. Okay, you want the 500,000 for Northern European expansion, but what does it actually entail to? So it doesn't bring much any value, let's say, to you. But yeah, that's, I would say, quite clear. And then we also have sometimes slides like this, 500,000 for pilot processor. Again, no context, no information. Yeah, good luck to them, yes. But okay, that was like a brief rundown of what we kind of missed from the session 2. But I guess I can now give the floor to Jirts to talk about Syndicate investments.
Many of you know me from the last week's presentation. So I'm Jirts. I'm a board member of Latvian Business Angels, and also board member of our investment vehicle, ASP Asset Management. And today I will talk a little bit about the syndicated investments. And for you to understand what is a syndicate, I'll just explain you a little bit how usually people can invest in different startups or any companies. And the first way of investing is direct investments, and that is how I made my first 12 or 13 investments. I was going directly to the companies, looking for them in different pitch events, and going to Estonia, to Lithuania, and coming also here and asking and talking with the other angels, like, do you have any startups, and what do you think? And that is how I did it. So I did quite heavy lifting, looking myself for the deals. And I remember the first deal that we invested in 3 business angels. We just liked the product very much. We didn't care what the team is, how much will it cost, what is the price of the company. We just put in the money, and we were pretty sure it is a very good business model, and that was quite bad decision, I would say. The advantage of it is that you have much faster decision making, so you have a gut feeling that you think this is a good founder, this is a good business, this will be profitable business, and you make very fast decisions. You can make the decision like in 10-15 minutes. I'm investing, and signing something maybe on one page contract, and then transferring money, and then many times not seeing it again. The disadvantage of private angel investment is that you do need very deep knowledge in, or it would be advisable to have a deep knowledge in the area where you invest in. So those ones who do invest as business angels, they invest into the areas where they are specifically not knowledgeable or know the area. If you want just to get better deals, then you should be quite wealthy, because if you come to a startup with 2 or 3 or 5,000 euros, most probably they will not take you very seriously, because you cannot really change the course of the company by putting such ticket. There is administrative burden, so you have to think about the contracts, you have to think what the other business angels will want to do. And it is quite best suited for investors with time, networks, and strong conviction. So if you're a really high net worth individual and you get other angels who just tell you this is a good deal, then that's really a nice way how to invest. And so you also get 100% of the upside, and of course 100% of the downside, and you don't have to pay any commissions to anybody. But I mean, that takes quite a lot of time, as well as a lot of time after the investment, because you do have to follow up the companies, and you have to ask them what their strategies are, check their reports, and have a network with the companies that you have invested in. The second thing is syndicate investments, and that is what we'll touch a little bit more in detail today. So there is a syndicate investor who coordinates the deal. So for Latvian business angels, we have an event like today, which will happen just within 1 hour. That we have special events where startups come, and startups are being checked and selected beforehand. So we do know that a little bit more about them. After during syndicate investments, you do get managed reporting and due diligence. Due diligence is something that we do here, and we have like close to 100 members. So we always find somebody from the network of the business angels who does have a deeper inside knowledge from the industry, and ask their opinion, and they give their network. In that way, we can get a much better understanding of the business. And syndicate investments also get monthly reports, and you will see if you join that you will get every month a report from each company, whether you have invested or if you ask to, then you can get the reports, historical reports from the company. The other advantage is that there is a lower ticket size, so you can go with lower initial investment, but invest in several companies, because there are several business angels who put this ticket together. You do not necessarily have to invest, and that is what I strongly, really suggest and advise, not to invest into the first idea that you really like. Just look at the idea, see how the things happen, just put your virtual 10 cents and then check how this investment is developing. And it's not only for startups, it's also like for stock investing and other investments. Just check and understand what you do really invest. Then you can also read the memos, watch the due diligence, how it happens. Maybe if you're an industry insider, you can help with the due diligence, do some inputs, and then see the results, how it turns out at the end. Then in syndicates, you can access deals that you would never be able to source alone, of course, unless you're a very high net worth individual, where people just come exactly to you. So here we do have deals also from other business angel networks, and some insider deals that sometimes even the startup community doesn't know from outside. It is just like an insider deals. Shared expertise, there are other angels who can explain and tell you their experience from the other investments and how they went and what were the red lines or red flags when they did invest. And the disadvantage of the syndicate investments that you do have a carry and admin fees. Carry and admin fees usually for VC venture capital investments. These are standard, which is 220. Means that there is a 2% yearly fee, but for us it differs from the amount that you invest. The more you invest, the less the yearly fee, and then the syndicate takes 20% of the upside if the syndicate makes profit. Then there is a third type of investments, which is investments in funds. That is typically available either to institutional investors who have larger money or high net worth individuals who really do not want to bother with evaluating each deal, so they just invest into the fund. And also Latban, we have invested into fund of funds, which is we have one investment in First Pick, which is Lithuanian fund. Then we have Outlast, yeah. Outlast, which is Altum fund, and then we have in
Build It.
Yeah, Build It. I can't remember their name. In Mattis, yeah. Then we have also investment in Build It, which does the investments just like we do, only we spread the risk by investing just in a fund, and we do control the deal flow. We have a say if we want to invest or if we do not want to invest, but it's more of a passive investment. So usually there is no say in individual portfolio companies, but we do have a say. We cannot veto it, but we can advise yes or no in these three funds of funds. Fund managers make all the decisions, so we do not have to monitor the companies or deal with the companies. They do it, everything for you. And usually there is a diversification built across 50 to 30 startups. That is what a normal, usual fund makes during their lifetime. And it is a good option if you want to have a passive exposure at scale. If you just have a lot of money, you just want to invest and sleep well at night and not bother about who is doing. Yeah, this is me. So like I said, Latvian Business Angels board member and also investment manager at our investment arm. So what is a syndicate? A syndicate is a group of angels pooling capital to invest as one. And as you can see from the picture, if we form a syndicate, we usually don't have that big 500, but we have syndicates starting from 100,000 up to maximum was, I think, 500 in Cellbox, something like that. So there are several, even several dozen of investors, like in Cellbox, where they just put the money together and make one syndicate. So lead investor coordinates sourcing, due diligence, terms, close, reporting. So lead investors are me and Ansis, and we negotiate the legal terms. The advantage of Ansis is that he's a lawyer himself. That's his daily job. He's mergers, acquisitions, licensing, bank licensing, and stuff like that. So with the every next startup, we include some additional points and issues that we have encountered with the startups that we have invested. So every next contract is more and more detailed, and we are trying to predict any problems that we might have. And it's just like in marriage, the best marriages are with marriage contracts, because you negotiate beforehand, and then when you have talked about everything, then you have much less problems than without talking beforehand. So we provide also platform, visibility, and structure. We also, like I said, we co-invest with other business angel networks. We are also cooperating with, like I said, Litban, Lithuanian deals with Estban, which is Estonian deals. We also take part in Latitude, which is Estonian event for the startups. We're also cooperating with Finban, which is Finnish business angels networks. And then we have some relationship with the Western European angel networks, but not that active because they're farther away from here, and of course they're more expensive in valuations. So also the startups themselves, they do like syndicate investments, because imagine you have a company with 20 small investors, and everyone wants to call you and tell you like how you should do the business, and everyone wants to spend half an hour to 1 hour talking to you. So basically at the end of the month you don't have much time to do your basic work, because everybody has their own strategies, and these strategies are absolutely opposite for each small investor. So in our case, Ansis and me are negotiating and also dealing with the startups, and at the same time we're dealing with investors who come and just tell their ideas, and then we're transferring to the startup. Also, the advantage is that there is a clean cap table, which means capitalization table, or the owners of the company. There is only one ASP Asset Management. Imagine for the next round, when you meet with the next investor and he has to sign the new contract with 30 different owners. It's a nightmare. Somebody is on a vacation, somebody has to take care of the dog, and it takes like a couple months just to get all the signatures. Here you have to get just one signature from the syndicate. Why syndication matters for angels and founders? So for angels, like I said, it's access, better deal flow, later stage co-rounds, so we can get a better deal flow. Like at the moment, we are actually not seeking out for the startups ourselves. The startups are contacting us. Emils has the burden of selecting first filter to selecting them out, and then the filtered startups come to us and to me and Ansis, and then we have more detailed discussions with the startups. Later stage co-rounds, it is very important that raising the first round is not that difficult, because people are excited. There is no track record, and I mean, angels are excited for investment and for the idea. There is no big track record of the team, And but what is important that the team is able to secure next rounds, so that they're starting to grow. They need additional capital. It means the same like for the business. You need additional money from the bank, but if you don't have any track record of your history, like how you have been performing, then most probably bank will not give you the money. And this is exactly the reason for us. So we have a good relationship with Latvian, Lithuanian, Estonian, Finnish funds. We work also with the other VC funds. So we, if the startup is really good, then we also help to raise their capital, their next round, and that is why they like us. Diversification. So you do not need to put in big tickets. You can just come with relatively small tickets and access more deals. Shared expertise, like I said, we have close to 100 different members from different areas of business, so we can do much better due diligence than you could have done just being alone. There is also a network of angels. Every angel has its own network, so we can get basically like close to 500 different people's opinions if necessary. Like I said before, the founder win, one party to deal with, faster close, and no hassle on reporting, so they just send one report and then we distribute the reports to all our members. So roles and responsibilities. So lead investor usually means the one who takes the responsibility for coordinating all the deal, because our syndicate many times is not the only investor. There are also other investors, so we have to agree also with the other investors on the deal term. Many times we are the lead investor, which means that we are negotiating the terms both with the other investors and with the startup. We always make the investment memo and due diligence pack, and many foreign venture capital funds, they purely rely on our due diligence. They do not do the due diligence themselves, and they use the due diligence that we have made. The lead investor, like I said, we negotiate the terms both with the co-investors and as well as with the startup ourselves. We align with the group, so we talk with the other investors what would be the best strategy, under which terms we can invest. We drive the closing, which means that we prepare all the contract for all the parties, post-close reports, and we represent the syndicate, which means that after investment we also push the startups so that and check so that startups report every month, because that is very important that investors get monthly updates. Syndicate members, before investing, you will see today, like there come all the angels, all the angels that take part in the event. We can always ask the questions to the founders, discuss, sign documents, and then after we make a decision that we will invest, then we send out the investment contract with each member. Then ANSYS checks that you are eligible, not under sanctions, and all the KYC and AML and whatever else the bank requires, because that is investment. Then you transfer the funds, your money, to the investment fund, and then that's it. So then you need just to follow up the post-investment reports. And that is about this. And the process, how it happens, this is also from the SEB over here. It's Tornated, which presented, I think, 1.5, 2 years ago. Also very good company that we invested in. So how it starts, we select 5, 6 startups for every session. Then the startups present. Then we send out in WhatsApp group the interest from the angels and the startups who have the biggest interest in investing. Then we start due diligence for due diligence process with them. After that, we draft a term sheet. We make a term sheet means negotiations under which terms we are investing, the price, the way of investment, the KPIs, and their commitments. Then we form, when we reach an agreement with the startup, then we form an SPV, which is like we have to register a new investment fund into the bank. It usually takes 1.5 weeks maybe. Then the investors fill out the KYC, know your client, and all the AML documentation, and then just wire the you will receive the instructions where to transfer the funds, and then you transfer the funds, and then you just start getting reports from the startup. SPV, special purpose vehicle. So the structure is that investors send money to the special purpose vehicle, and then the special purpose vehicle sends all the lump sum to the to the startup, and SPV is the owner of the company or co-owner of the company, while at the same time the smallest investors are the owners of the SPV. And that's in that way there is, like I said, a clean ownership structure into the startup. The SPV vehicle takes care of the administration costs, agreements. So if you are an angel, so quite often if you want to pay the lawyer for the different contracts, it might cost several thousand, 2 to 5 to 7,000 euros. And that is what the management fee is for, that all the members who invest, they just invest a small share of these administrative expenses. So the fees are, like I said, standard industry, which consists of administration fee plus carry fee. And so for us it is 2% yearly management fee. And like I said, it is different up to 20,000 investment, 1.5 from 20 to 50, and 1% 50,000 or more. And the fee covers administration, reporting, also to the bank, reporting back from the startup to the investors, as well as legal compliance. And then there is a 20% carry fee, which is 20% from the profits, only from the profits that you make. And this is a small math example, and Emils will send you the presentation so you can calculate yourself how much will it cost to you, and just put it in the Excel and you will see it. Yeah? So the Latban due diligence checklist, and I think Emils, you will show it, our standard or one due diligence, but later on I will just explain, and Emils will show you later on how our due diligence looks. So the things that we check and test is the founders and team. We check their CVs, their competencies. Vesting means that they own some kind of shares, but so they have to work for some certain time into the company just to get these shares. They're blocked. If they leave after 1 year, there are different clauses and conditions under which you can leave or cannot leave the company. So we check all these legal aspects. We check their competencies, and very, very important factor is coachability, so that there is that's how we can communicate with the person, because sometimes, like for for all of us, it's impossible to work together with the person, and if we feel it already from the very beginning that it's quite difficult to work with the person, then we pass the investment. So founders and team, just like I explained last week, they compromise about 50% of the value or of the weight in our due diligence. Then the next one is product and technology. So product roadmap, how will you develop it, how will you go to the market, security, how easy is it to copy, what is the uniqueness, how easy and how easy, difficult, or how expensive is it to scale your product, how you can integrate with the other markets, with the other platforms, if it is a software as a service product and stuff like that. Then we check the markets. Are the prices, what the startup tells us, really correct and valid? We check the competition, and we check if the startup is giving us the correct competitors, or if they have missed something that we have found. Sales and go-to-market strategy, customer acquisition costs, sales funnel, how they are going to build their sales network, retention, how many clients stay with them after half a year, after 1 year, paying clients. Realistic sales growth, quite many times it is very important for us to ask in what way, like what is your belief, why will you, how will you be able to achieve such a sales growth? And they have to be able to just tell that this is how we will proceed and this is how we will grow it. Like I said also last time, churn rate. Churn rate is how many paying customers are leaving you after some kind of, let's say, 1 year or so. We check the indicated market size. If the market is correct, that the company is in. Then ANSYS does the heavy lifting in legal. So we check all the shareholder agreements. So it is not a red flag if they do not have it, but before investment we make sure that they do get it, or just right after the investment we make sure that the founders of the company do make shareholder agreements. We check intellectual property. If they have registered it, sometimes it is necessary. Sometimes if it is just a software product, then there is no IP as such. Then terms of service compliance, employee option pool. So that is very important because the next employees who will join the company, they will get some kind of shares from the employee option pool. These are the shares that belong to the company that do not belong to the founders. So in that way they can motivate the most important employees of the company. We check the contracts with the suppliers, with the clients. We also check that there is data privacy, GDPR, regulatory, different aspects. So it's quite a detailed check. We check also business models. What are the margins? Are the margins sustainable? Are the margins similar to what the competitors have? If we can, of course, achieve such data. We check the revenue streams. We check pricing models. How the price is being built. Is it fixed price plus some kind of percentage from sales or from turnover or something like? How do you build your pricing model? Then it is very important financials, burn rate. Burn rate means how much money you lose every month, because at the initial stage you have to finish the product. By finishing the product, of course, you don't have any revenue yet. And another aspect when you burn the money is when you scale, when you start entering the new markets. Maybe in the local Baltic market you're profitable. If you want to go into, let's say, the entire Europe or US or Canada, then you'll have to invest heavily in marketing, and those costs will be higher than actually you can make from initial immediate sales. So we do check all these financials. We also check salary pool, because that's a point where we pay very big attention to that. That the startup doesn't raise the money and then starts paying itself 8,000 euros a month just because they're super duper specialists. So they have to also have a skin in the game, and they have to work, well, we consider just below the market salaries. I'm talking about the founders, not about the employees, because they do have to trust their idea, and they do have to take some kind of pain or, like I said, skin in the game, just to prove that they do believe in the product itself. Then we check the cash flow, runway, unit economics, so basically that's all the financials. Then when signing the contract, we also, before signing, we agree which are the KPIs and reporting plan, what will be reported, what numbers will be reported. For all startups, for us it is standard once a month, they just send us the updates. We have some difficulties, we have to remind them every month, but eventually we get it. And then now Emils will show you one of the investment opinions, and it was this was for a Lithuanian company, VRD, which is analog to Duolingo language learning application, only adjusts to your individual learning speed. So this is the basic things. Can you just go up and I'll just go through? Yeah. So like you can say, like the weight, founder assessment. I'll start with the verdict. So our standard value is that we're evaluating if the startup is capable of returning 15x in 5 to 7 years. So that is the basic mathematics, because eventually some of the startups, 30 to 50% will bankrupt. About half of this 25% will return your initial money, and only these out of these 25, there is a probability that they will return all your money, and that is why we need to expect such a return. And if the company is not able to return 15x, then we unfortunately cannot proceed, because if it does go like if it is successful, then it might return you 5x, but it will not cover you all the losses for the other companies. Then I will the aspects that we talked about. Then founder assessment, the team. So we put 50% weight, and in this case there were two founders who had already put in $2.4 million into the startup, which is it was very well funded. Then market thesis, if their market idea just is valid, we put 30% weight. And product and traction, these guys are working for slightly more than a year and have got already 1.3 million US dollar revenue from the US market, which is very good turnover, just slightly more than 1 year. And then we check all the unit economics and what is the feasibility to make 15x return. We check with the other industry sales for how much other companies have been sold. Then we check the moat durability. Moat is the ability to protect your idea so that somebody doesn't just easily steal it. Then bootstrapping effect. This is just for this startup. It's not for everyone. And then we just go with description of the business, and Emils will send you, so I will not go that much
into it.
We
will also send you an example just so you can take a look.
So you can take a look, you can read it, because this is reading before going to sleep.
Yeah, but yeah, getting back to the presentation.
Yeah, and then getting back to post-investment reporting. So, like I said, we get monthly reports from all the startups. By signing the contract, we identify the KPIs, monthly recurring revenue, churn, burn multiple, runaway, different risks. We also want to know about the hiring, whom the startup is hiring and how much salaries are being paid. Then we also try to get once a month or once in a couple of months office hours, really to meet with the startup, discuss their strategy, maybe find out what help they need from us. Then that is it. Then lead investor. So when you choose the lead investor, it doesn't matter is it just for us in Latban or you go to Lidban or Estban or Build It. Build It just came. Hello, Matis. Then for the lead investor, you should also take a look at their track record, what investments they have made before, how successful these investments are, how they follow those investments, how they report to investors, what memos investors do get. Do you get communication with the lead investor or not? Can you call him? Can you ask him questions? And does this lead investor has skin in the game? Skin in the game means that they have invested their own money. There is a saying, put your money where your mouth is, or something like that. So a bad lead is overhyped deals. It's like this is the once in a lifetime opportunity and quite unrealistic data and quite unrealistic returns. Also saying too good to be true. There is weak due diligence, so that more emotions and less really numbers. And poor updates for post-investment. You can also ask for previous investments and ask for the updates or reports from the date of the investment. And you're not investing just into the startup, but you're also investing into the lead. And the lead is the one who is responsible to follow and lead the startup and help him out in case of difficulties and help also with the next round. Good? 2 minutes, okay. So typical problems that you should be paying into when selecting the lead investor. Do not blindly trust the leads. Do not trust everything what he says. Just check yourself all the numbers, all the data, but that's true in everyday life decisions. Poor reporting discipline. If there is no discipline in reporting, then there will not be discipline in anything. Legal gaps, convertibles not converted. That is the legal term. I think Ansis will just describe you a little bit more. IP, like intellectual intellectual property. Forgot. Not secured. That's also not quite a red flag that takes time, but you should still consider that the lead has thought about it. And misalignment between startup and syndicate investors. So syndicate investors might want to invest in one area, like let's say in software, but he is just pushing you for some kind of different, like hardware or biotechnology or space or defense area, just because that is a hot deal. If you have your own area of expertise, then just stick with it. And change in business strategy. Of course, the business strategies do change, like our minds change every day. But I mean, the general tendency should be the same over time. And your first syndicate, I think that you can stay for today's session, and then just talk with our members and then see it and feel it yourself. And that is, I think, that I can finish with this slide.
Yeah.
Thank you.
Applause as well.